Chris, I love your story, especially since you were a financial advisor and then you became what you term an anti-financial advisor. Tell us a little bit more about your background and how you became an anti-financial advisor.
I started to realize that none of my clients were financially free, nor were any financial advisors in my office financially free. So why would I keep doing the same thing expecting to get different results? And so I started looking outside of that. And that's when I started finding things like real estate investment and other alternative investments.
Where do you invest in real estate today? Do you still manage it yourself, or are you more into syndications these days?
Definitely apartments, I think, is something to start really keeping an eye on, because this is how you know what to invest in, is when everybody tells you not to do it. When everybody says, these are bad investments, or I've been burned, don't do that. That's exactly the time you should get greedy. When everybody's fearful, as Buffett says, right? When everybody's fearful, you get greedy. When everybody's greedy, you become fearful. Well, look for those little investments or markets where people get fearful.
And you can get rid of risk, but you can be smart about risk. As you get more and more successful and your monthly cash flow starts increasing, what tips do you have for people to avoid lifestyle creep?
Well, it depends on who you are. If you're listening to this right now, if you have more spender tendencies, right? Just pretend that money is not yours. Be very careful. Be sure you're monitoring your expenses. One thing I have all of our clients do is we actually have them track their money each month. And ideally weekly, not just monthly, but actually weekly, watching how they're spending money. If you're more of a saver, be okay not to give yourself too hard of a time or guilt trip. If you're already a natural saver, the thing is that you're going to feel guilty about spending any dollar you have in your life. And so I would challenge you to be okay maybe spending a little bit more money. It's always about progress. Just keep, monitoring what your cash, be responsible with it, have your cash reserves, and then invest everything you possibly can.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice.
Welcome back to the Money Seed Podcast. My guest today is Chris Miles. Chris is famous for his show, The Money Ripples Show. Chris, welcome back to the Money Seed Podcast.
Hey, it's great to be back, Gabe.
Chris, it's been about a year since we last connected. What have you been up to in 2024?
My goodness. I mean, a lot of the same. I guess there's not a whole lot of change that way, although I am getting ready, trying to launch a book. So I haven't announced that publicly really yet, but there is a new book I'm going to be coming out called Down Millionaire, which kind of talks about my story and how I was able to go from millionaire to upside down millionaire, where I was over $1 million in debt, then came back again to be able to be financially independent again when I was 39. So kind of that whole story and that journey, and I really talking about the same thing we're going to be talking about on the show, even though I'm sure I'm going to try to extend it to at least 100 pages. That's my challenge. I'm not very good at having long, verbose type of things, unless I'm doing a podcast with you. But other than that, I usually don't try to go very verbose when it comes to my writing.
Chris, I love your story, especially since you were a financial advisor and then you became what you term an anti-financial advisor. And for those who want to listen to the full story, please check out episode 84 with Chris. We get into all the details. But at a high level, for those who haven't seen that episode, tell us a little bit more about your background and how you became an anti-financial advisor.
Well, it started by being a financial advisor, like the traditional mainstream salesman in a suit, selling you mutual funds and insurances like every other financial advisor does. I was 4 years in, and then one of the inspirations for me going into that was my dad, because my dad, other than teaching me that, there's not enough money, we can't afford this, we think I am made of money doesn't grow on trees, you hear all those kind of things. But the thing that really inspired me was he kept telling me growing up, he said, Chris, I'm going to literally die working. Like my job will kill me, because he'd already had strokes and heart attacks by his 40s and 50s. So I wanted to give him some of his life back. I became a financial advisor as a result, right? And as I did that, my dad, 4 years in, when I was a financial advisor, my dad said, listen, why don't you advise me at some point? So I sat down with him at his table and we're looking at all his finances, and he paid off all of his debt, all of his mortgage and everything was debt free. He'd stuffed his 401k with matches and everything else. And despite all that, I said, Dad, even though you're 61 years old and you've done everything right, you better hope you die in 5 or 6 years if you want to retire today, because you're going to run out of money. And he said, well, that's not what I want to hear. It wasn't what I wanted to say either, right? And of course, as a result, that's what got me looking for other answers, because I started to realize that none of my clients were financially free, nor were any financial advisors in my office financially free. So why would I keep doing the same thing expecting to get different results? And so I started looking outside of that. And that's when I started finding things like real estate investment and other alternative investments to the point where later that next year in 2006, I was able to retire when I was 28, almost 29 years old. I had enough passive income coming in to pay for my expenses. And of course, when you're 28 years old and you do that, everyone wants to know how you did it, right? And so I even came out of retirement in 2007, started teaching people how I did that. Then the recession hit, kicked my butt with real estate, kicked my butt in the new business that I'd started with some partners. We barely avoided bankruptcy, barely. And I mean, barely. It probably would have been easier if I went bankrupt, actually. But I was able to dig out of $1 million plus debt hole, doing it again with no money, no credit. Really just finding and free up cash and just trying to be a wise steward of my money. And eventually I had enough cash to build up again and start creating more passive income. And so I had to do it twice. People are like, wow, how'd you retire twice? I screwed up the first time. That's how, but I've now kind of since, learned the lessons, and I've now helped many others do the same thing, which is probably, I'm more proud of that than just my own story.
So how does that conversation typically go? Because most people, as they grow up, the only option they ever hear is that you only have one option for saving for retirement. And that is just stuff as much money into your 401ks and your IRAs as possible. That's all you can do. And most people think, okay, that's safe, that's good, that's a smart thing to do. Every financial advisor tells them that's what they got to do. What did your first investment look like that wasn't a typical 401k mutual fund?
Yeah. Well, address that first part. I mean, when people say it's safe or they're being conservative, and I hear that, usually it just means they're being comfortable. People aren't conservative investors, they're comfortable savers, right? And what I mean by that is, like, many people will just go with the mainstream thinking that the mainstream way is safe. But let's look at the evidence. End of 2023, Fidelity came out, and out of 45 million accounts, only 810,000 have at least $1 million. And remember, if you go by traditional financial advice, right? Traditional financial advice says, you got $1 million, you live on 3% a year, that's 30,000 a year. That's just not going to cut it. And so that's the problem, is that only 1.8% of people can live on 30,000 a year or more, right? And that's why 35%, this is a Transamerica study that same year, 35% of those that had over $1 million said it will take, quote unquote, a miracle to be able to retire, right? That is the big issue that we're running into right now. So people become not conservative or safe investors. They actually have almost a guaranteed chance of failure if they do the traditional stuff recommended by most financial advisors. And so the first thing that I did when I broke out, first, I was excited because I started to see possibility. But the first thing that I actually did was I turned my first home into a rental, right? I started doing that. And here's the thing that blew my mind is, when you think about it, that rental property I bought for $116,000. I put a 3% down payment because it was an FHA loan, right? So I put down a whopping $4,000. Now that $4,000, 3 years later, I was able to sell that property off and then lease it back again to rent it out. That's a whole nother, it's creative strategy, right? But I end up, selling it to another investor at $160,000. Now, some people will say, okay, cool. Went from 116 to 160. That's still a good return in 3 years, right? But it's not just in that case, it'd be roughly about a 40% return. No, it was much more than that. My $4,000 turned into another $50,000. I did over 10x on my money, if you think about it that way. And that's the one thing about real estate investing I never realized as a financial advisor. I was always looking at, I pull out those old Ibbotson charts, as they call it, right? Where it shows, like, if you had $1 in 1928 invested, you have it in inflation, it'll be $4 or $5 or whatever it is, right? And then you got $1 here. Actually, it should be more now, but government lies about inflation. Then you got $1 in real estate, only the average is 4% a year. But hey, if you put in the small cap stocks, it averages 12% a year. So you should put your money all in the stock market, right? But what I didn't realize is that there's things like leverage and things you can't do in the stock market that create a lot more money. And so that's what I started to realize. Like, even recently, now I can't always do, I'm not doing 3% FHA loans anymore, but even if I put 20% down on investment property, like I did 6.5 years ago in Memphis, Tennessee, well, that money, that $32,000 I put down with closing costs, $32,000 total, has now generated over $165,000 between appreciation, cash flow, not even, paying down my mortgage for me. My renters pay down my mortgage. So there's equity built from the mortgage being paid down. That's not even including any tax advantages, right? Where if I had that same 32,000 in the stock market 6.5 years ago, that 32,000 would become 65,000. I would have doubled my money, but I have $100,000 more because of real estate. And I think that's a safer way to go because real estate is historically safer than the stock market. And when it's used the correct way, it can make you a lot more money. And it doesn't have to be a rental. So that's what I started doing. Started doing rentals. I also started realizing I could lend my money out. I could actually be the bank for other investors where they would pay me returns. Now, I'll tell you, it was easier back then, right? Back then in 2006, especially, everybody was euphoric, right? This would be like 2021 in a sense. So people were paying like 2%, 3% a month on your money, which was not a sustainable model when things slowed down, right? So, but I mean, that's really the kind of things I was learning about and doing. I said, wow, this is amazing. Because even if I had $300,000, right, and I pull off 3% a year in the traditional mutual fund, that's $9,000 a year. But with that 300,000 could even pay me, 1% a month. That's now $3,000 a month, not $9,000 a year, right? I mean, it's that whole cash flow, that passive income aspect versus accumulation, right? That you're always taught is what revolutionized my whole mindset and realized that there was actually hope for people. And that's really what got me to want to teach people what we're doing and, why I could be retired and live in a quiet, easy life. I don't, because I feel a duty, a responsibility to help people wake up to see like what's actually possible for them that really for a lot of people, they see as a hopeless situation when it comes to retirement. They think they're gonna have to live on a fixed, very small fixed income and begging for Social Security to take care of them.
Yeah, that's one of the scary things that I think everyone should do is when someone tells you go to a financial advisor, they say that the safe withdrawal rate is between 3 and 4%. Some financial advisors say it's 4%, some say it's like 3.5. I think you used the example of 3% earlier. Like if you want to have like an average income of $50,000, $60,000 a year, maybe you want to have a nice retirement of $100,000, $150,000 a year. Like you need millions and millions in your various investment accounts for you to get that kind of a consistent income using a 3% or 4% safe withdrawal rate. I mean, it's almost like as soon as you look at those numbers, you almost have to conclude that I need some other plan. Like this is just really not the best plan out there.
Yeah.
So getting back to real estate, I think a lot of people start in real estate the way you described it was, hey, I have a house, I moved, I can sell it, I can rent it, I'm going to rent out my house and see what happens. And so people kind of get into real estate accidentally, but then they start to get more and more sophisticated. Eventually, I mean, I think the upper end of that is you can join syndications where you have professionally managed syndications where an investment group that does this professionally and all the time, they buy an apartment building, they invest in it, they bring up the rent, they increase the value, they refinance every 5-10 years, that kind of thing. Where do you invest in real estate today? Do you still manage it yourself or are you more into syndications these days?
I mean, when I manage it, I mean, I'm managing very passively, right? So I'm letting other people do all the work. So, for example, beyond having rentals, I do lend money. I think right now, lending money has been, really the last 2 years, lending money has been a great way to go, right? Even a lot of people in the apartment space and different, real estate spaces have started to say, you know what, let me just do a debt fund. I'll pay you a fixed rate. I take all the equity. You just get your fixed payment. And I'll tell you, a lot of our clients have been very happy with that. They're like, man, if I can make 10, 11, 12% a year, just lending out my money, I'll do it all day long. I'm hands off. I'm out of the weeds. Let somebody else deal with all the hassle, right? And that's kind of how I invest too. I will tell you, looking at 2025, I think apartments are going to be making a big comeback. I really do. I'm already starting to see that turn the corner today, even as we speak in 2024. But I started to see, I think in 2025, you're going to see a big change there. I know self-storage is a little bit lagging behind. They're having a hard time. But definitely apartments, I think is something to start really keeping an eye on because this is how you know what to invest in, is when everybody tells you not to do it. When everybody says, these are bad investments or I've been burned, don't do that. That's exactly the time you should get greedy. When everybody's fearful, as Buffett says, right? When everybody's fearful, you get greedy. When everybody's greedy, you become fearful. Well, look for those little investments or markets where people get fearful. And apartments have been, it's created so much fear, so much loss, especially those that were doing, very variable rate mortgages because they're just doing temporary lending to then turn around and refinance later to get better financing later. When they got burned in 2022 because the Feds just jacked up the rates way too high, way too fast. I mean, that even got the best of even the best operators suffered during that time. But now we're starting to be at a point where values have got back into balance again. Apartments are starting to be in a better place. And so I think you're really going to you're going to hear whisperings of apartment syndications becoming better, but you probably want to hear about it being awesome until probably 2026, 2027, when everybody's already started to make their money.
Let's get back to private lending. I think you mentioned that nowadays you're doing a little bit of private lending as well. And you mentioned some very impressive returns. I think 10% or even higher is what you mentioned. Tell us a little bit more about who is borrowing at that kind of a rate and still making a profit in real estate. What kind of projects are seeking out loans at 10%?
A lot. Often it's either people that are doing fix and flips. Could be people like that, where they are turning around a profit over a period of time. And that could be in the single family, could be multifamily, but it's usually more in the single family space. Even people that are doing like buying up bad debt, buying up note investors. I know, one company that I've known for years, the guy's been doing it for decades. I mean, he's paying like 1% a month on his things. I know another guy, he's a real estate developer. He literally does like land development to build to rent for single family homes and whole developments, just like, D.R. Horton and people like that does. He does the same thing, doing the same kind of deal. He's renting in the double digits, or not renting, borrowing at double digits and just paying him a flat rate. So then he can keep all the profits, keep taking the cash flow from those properties and so forth. So you're really seeing it more in mostly in the residential, sometimes commercial, but mostly in the residential space, I'm seeing it.
So when you invest in real estate, generally speaking, what kind of a cash flow? And maybe it's not just real estate, maybe we can talk about notes as well. But when you look at your own financial models and you say, okay, this is the kind of passive cash flow I need, what is that sweet spot? What kind of a return excites you before you say, okay, you know what, let's kind of move forward with this investment. It looks good. The numbers work out.
Well, first and foremost, my number one concern is always not the return on my money, the return of my money. Because I don't care if somebody promises me the moon and the stars, like the ATM funds, for example, right? Like so many people have been burned in ATMs recently because they're talking about big tax breaks, tax advantages, because, you can get write-offs on this and you can even make 26% rate of return, And I remember when I had several clients and they thought I was crazy because I said, listen, one, it's technology based. Two, we'll eventually go digital. I don't see this as something that has much of a future. Have you done this 5-10 years ago? Great. But I don't know about now. Like it could be short lived. And now we're hearing about tons of these ATM funds folding, right? Like just going under, people losing money in these. And so you got to be careful about chasing rates of return. Never, ever let tax breaks, tax advantages of any deals, never let rates of return be the reason why you do or do not do an investment. Never do that. So I always think, how can I ensure that I get the return of my money? Then secondarily, great, can I get a decent return on this money, right? And I generally like to aim for double digits, at least 10% is what I like to see. It's possible that there could be good investment, might be like 8% or so. I'm in an investment right now, pays about 7%, nothing exciting, but it's boring and does its thing, But I also have other things to offset, to kind of diversify my portfolio a little bit differently. But typically speaking, if someone comes to me and they say, I've got $500,000 to invest, what kind of income could I generate? I generally say, well, conservatively, because there are some that can pay more, let's look at 10% as that benchmark. So if it's 500,000, that means you can make 50,000 a year on that money. The hard thing is, a lot of people love it and they do it. As long as they do it wisely, it works great. And that's why sometimes having that guidance helps. I remember I had one woman, she had $250,000. She was a health coach. And she told me, she was in her mid-50s, single, living by herself. And she said, Chris, I want to retire in the next 10 years. And I said, all right, well, what do you got? I got $250,000 in mutual funds. Okay, what's your burn rate, so to speak, right? Like what's the expenses that you need to be able to pay for? She said, only $2,000 a month. Now remember, this is 2019, right? And so this is pre-2020 and all the hyperinflation we saw since then. But she said, I just need $2,000 a month. I said, okay, great. And you want to do this in 10 years? Yeah, but the financial advisor I was talking to, he says I'm going to have to save a lot more money. I said, well, you do, because for $24,000 a year, you probably need to get your $250,000 up to $1 million in 10 years. And that's if inflation doesn't happen, right? And especially after paying taxes and everything. I said, but if we can make 10% on that money instead, that $250,000 pays you how much? She said, well, that'd be $25,000 a year, which is how much per month? about 2,000 a month. You got it. She's like, wait, are you telling me I could do it this year? Like, you could. I'm like, there are no guarantees, but you definitely could. I mean, if you want to be conservative, wait a year or two, but you don't have to wait 10 years and then hope and pray you quadruple your money in the market, which it hasn't done yet. And so she's like, wow, that's amazing. Here's the sad part. She went and talked to her friends over the weekend, and her mind has expanded, got shrunk right back down to where it was. She said, I was talking to my gal friends, and I decided that I'm just gonna, keep investing in the stock market. Okay, so let's just say she happened to have maybe $1 million, but still, that might only kick off for her about $15,000 a year, right? Now, contrast that, I had another client who had $250,000. He was a guy that works in Hollywood, and he took his $250,000, bought several properties, and did some things with that, to the point where now he just told me a few months ago, he says, Chris, I'm just updating my numbers. One, my net worth just boosted up over $1 million, but two, that $250,000 now has not only grown to about 2/3 of a million, hit about 665,000, but I'm getting paid about $3,500 a month of cash flow, right? Same $250,000, same time. He came 2019, and 2020, by the way, set him back because he worked for Hollywood. They were shut down for half the year, so he wasn't saving as aggressively. And then secondly, they had the strike in 2023 that also shut them down for a half of the year. So he was even more disadvantaged than she was. And yet he was able to do so much more. And I think that's a lesson that we should all take, is realizing that, it can be a long game, yes, but it doesn't have to be as long as you think.
Yeah, I think one of the things that's holding people back is the mindset of just being risk averse. I think most people say, okay, if everyone else is doing mutual funds and all my friends are telling me to do mutual funds and stocks, that's safe, right? Like people think, okay,
Right.
that's where I'm going to lose the least. Has the least chance of just, kind of burning to the ground. And it really limits people on the upside because people never get upset over the money they could have made. People typically get upset over the money they lose or the money their account goes down by. And so, yeah, people are risk averse. And so they just stick with whatever is safe. And I think
Yeah.
that's probably what happened to that woman that you mentioned.
Which is ironic because I look at it as like, well, let's look at the history of the market, the stock market. How many times does it go down? Usually for every 7 years, it's going down 2 years, right? Where real estate, the only time we watched real estate really depreciate, and I'm talking about residential real estate specifically, was during the 2008 recession. But the other 6 recessions, real estate either stayed the same or increased in value. So who's taking the bigger risk? Who's taking the bigger gamble? Just because 3 billion people all lose money at the same time doesn't make it safer, right? Just because you're losing money just like everybody else is, you're like, well, at least I'm just like everyone else. No, it's better to preserve your money and not lose it in the first place. Keep it in a place that has real assets backing it up versus gambling in a place where it probably won't come back to you, at least not anytime soon.
Yeah. And I always feel like you can manipulate people through fear, right? So if you were trying to convince somebody not to invest in real estate, it's very easy. Tell them about, the 3 T's, where they like toilets, termites, and tenants, and bankruptcies and fires and insurance companies that don't pay out. It's very easy to scare people into saying, hey, you know what? Don't do real estate. It's super risky. Whereas like mutual funds, hey, it's professionally managed and they got these super smart people on Wall Street. You got nothing to worry about kind of thing. It's very easy to convince someone that, that's where they should park their money. But the example you laid out where traditional financial advice, 3%, 4% withdrawal rate versus if you start investing for cash flow, you could be getting like 10% a year on your net worth in passive cash flow. That's a huge difference. Like that is a life-changing difference.
Absolutely. It really is. That's what got me excited after I quit being a financial advisor. Like I was on cloud 9 and I even had friends asking me, they're like, well, how much money have you made? I'm like, nothing. But just the fact I can see what's possible is exciting. Right. And that's the thing. It's true. Like in real estate, there's always risk. Yeah. You can absolutely lose your money. Now, if you're buying a property and you own it and control it, the likelihood of you losing all your money, pretty much just about impossible, right? Unless you're investing with somebody else and you're in a different position and things like that. There are ways to lose money, and even in syndications and things like that, we've seen it happen. So never think that you're risk-free, even in real estate, but don't think that you're not taking risks when you're in the stock market. Because I witnessed with my dad. My dad had to wait till his 70s to retire. Because with him, see, you gotta understand, guys, that in the year 2000, the market where it was at the height, it had just started to come back up And then in 2007, it just barely hit where the previous high in 2000 was. So you had to wait 7 years to finally get back to making your money. If you had just parked 100 grand in the stock market, you'd be like, good, it's finally back to 100 grand. And then bam, then we have the Great Recession. And people, because they were paying fees, you mentioned about of course, the financial companies, always, taking your money and whatnot. I mean, financial companies always make their fees. They take no risk. They always take that money. Even if you lose money, they're still getting paid. How unethical is that? Right. And when you look at the fact that, 2008, the global financial crisis, stocks tanked again. When you factor in those fees, most of my clients that had put money in at the height of the market in 2000 didn't say they actually had their money back until about 2014 or 2015, waiting 15 years to get back to breaking even, only to realize, oh, with inflation, now I actually still lost 50%. So it really wasn't until like 2020 when things started to take off, they finally said, now I've made some money again. And that's the thing that people think is safe. I mean, when they say you're in it for the long haul, well, how long is the long haul if you're just about to retire and the markets tank again? What happens to you at that point, right? You're literally just hoping to time the market, and they'll just tell you, don't time the market. You don't know enough to do that. You lack the time, the training, the temperament, the 3 T's that they talk about as financial advisors. You talk about your 3 T's. We had 3 T's too. You lack the time, the training, and the temperament. And so they would tell us like, no, just keep dollar cost averaging, throw it in there all the time. Well, dollar cost averaging works best when the markets tank and you buy cheap. But notice they always tell you to buy even when it's going up. So really, you're not dollar cost averaging in a good way. You're constantly buying as it's going up too. So, they're just telling you, just keep putting money in, which is a perfect model for a business that's a financial company to tell you how they make more money, right? They're guaranteed to keep making more profits because they keep convincing you to throw more money in while they take out the money, whether you make money or not. And so take that control yourself. You have the ability to do that. And yeah, you might need some guidance, that's fine too. It's not, like I said, it's not risk-free in real estate either. And I've seen a lot of people just invest into random things and lose a lot of money. Even like certain mastermind groups I've had some people go into, and of course that mastermind group's promoting only their deals. So of course, when those deals all go south, then everybody loses all their money, I was fortunate, to hear from one of our clients that had been in one of those groups, and he lost about 25% of his money there. But fortunately, the other 75%, we had him investing in different things. We did go up. So the cool thing is he even told the other clients, we have like a community where they talk to each other too, and as well as coach them one-on-one. And so he was telling the community, he's like, I did lose 25% of my money, but the other 75% still doing better than if my money had stayed in the stock market because of those better, more consistent returns. And so that's the thing, is that you can reduce risk by, just not gambling too much in the real estate side either, by throwing your money all in like one deal, all into one type of operator, those kind of things. Like I have some clients where they love like this oil and gas investment, that is in our network. And mainly because the guy is such a good salesman. That's the main reason. And I had to tell my clients, like, listen, like I can't give you financial advice. I'm not giving you investment advice, but as a rule of thumb, I would not want to put more than 30% of my money into any one operator. Even if it's multiple projects, I wouldn't want to do that just in case something goes wrong. And lo and behold, I had one client that already did put over 50% of their money with this one guy. And remember, the money is still making money, but gas prices have gone down, so they're not creating as much profit right now. As a result, they're saying, and they put like $2 million with this guy's projects out of all their money they had. And they said, hey, we're making $8,000 a month less, almost 100 grand a year less than we're projecting. I was like, yeah, because you put almost, more than half your money into one kind of investment. You got to really diversify. Even in our space, you want to diversify a little bit more. You don't have to diversify among hundreds, but it could be diversified among like 4, 5, 6 even, and try to create a little bit more safety that way.
Yeah, and you can get rid of risk, but you can be smart about risk, right? So
that's right.
People are always looking for this one magical investment that's going to give them like this really great return of like 10% or higher and has zero risk and it's guaranteed and like it doesn't exist, right? Like if you want a risk-free rate, you can get some bond at like 3% or 4% that's guaranteed by, the faith of the US government or whatever. Anything above that 3%, 4% has some amount of risk. And so I think what you mentioned just now is how to be smart about the risk. You mentioned spreading the risk around, right? Don't just go with one operator. You mentioned, I think 30%. Don't put more than 30% of your net worth or your investments with one single person or one single type of project. How do you personally, Chris, if I may ask, how do you spread your investments around? Are you just in real estate? You're a little bit in lending? Are you in oil? There's some other stuff like I heard about car wash funds. You mentioned ATM funds. Somebody on my show a while back, they were talking about like life settlement funds. Like there's all kinds of places to invest. Some people invest a little bit of their net worth in gold or crypto. How do you spread around your net worth?
Well, the first thing is you got to understand like what goal are you going for, right? I mean, this will eliminate a lot of the options you're looking at because, for example, you got to have the right vehicle. I'm not going to drive to Paris, France. If I do, I will drown. No matter how buoyant I think my car is, no matter how Japanese it will still sink into the Atlantic Ocean, right? I got to have the right vehicle to get me where I'm going. So the first question I often will ask my clients are like, where do you, what are you trying to focus on? Do you want to have income right now, or do you want growth, or do you want both, right? Like and what's the time frame? Because if someone says, I need income now, like I had a woman who said she just got laid off out in Silicon Valley. She's a consultant at least, so she's making some money, but she's saying, I need to get my money working for me. I was like, okay, well, there's some growth options you could be doing, but I would probably suggest more income now. She's like, well, yeah, that's what I would want. I need something to make sure that even if I lose all my work, I'm still okay. So for her, that's great. Now I get some other people that are like, I'm in my 30s. I'm going to keep working for years. Even if I become work optional is what we kind of call it, right? It's where you work because you want to, not because you have to. They're like, I want to get that point, but I'm willing to let my money grow more. Okay, that's a different bucket of investments, right? That's where like turnkey real estate, rentals. Right now, rentals are not great on the cash flow side currently, but they can be a great steady way to create more growth with your money over the next 5 or 10 years. So that could be a great safe place to put your money, right? And so I'll have people, and then sometimes I'll get people that they only want to lend their money. And I'll say, maybe you want to diversify away from just lending your money, because they're going for just cash flow. Lending is a great cash flow play, like we mentioned before. But when it comes to other things, like, well, maybe we want to diversify. Maybe we do want to have some money in, buying some actual property too, right? Maybe we want to do some things like I have a raw land business partnership that's doing great. I mean, it's almost $500,000 invested, but it's making over 11,000 a month in the last 3 years. Now I have other clients that, they're like, hey, I'm only 2 years in, it's only like 3,000 a month. I'm like, just wait. If you reinvest, just wait. It does get better, but it takes that time. That's a growth play, right? So I even told that woman, I said, you need income now. This you could actually do, but by the time it starts really kicking off returns, it might be a ways down the road. So maybe we focus over here instead. Oil and gas could be good. I look at that more as a growth play as well. It does have some cash flow elements, and you do get some tax advantages when you do oil and gas. I'll just say this, oil and gas, you've got to be very, very careful. There are a lot of crooks in that space, a lot. I've seen them over the years. So you got to be careful, especially when people start talking about working interest and stuff, when it's more speculative. You just got to be aware. But there are some good players out there, and you can make, at least high single digit, maybe double digit returns as well. So there's definitely things there. Like I said, syndications lately, in the last 2 years, we haven't been as bullish on syndications, especially in the apartment or self-storage space because of what we talked about earlier. But, you mentioned car wash businesses, right? I mean, we have some clients doing car wash type businesses and making money from that, and very pleased, in what they're doing there. I put that a little bit of a higher risk category just because there's a business element too. And you got to be, very careful with finances, with trends and economies and things like that. But that could be good too. And so, yes, you can diversify among these different areas, still have real estate backing it up, but have very different kinds of real estate. Just like my raw land is very different than apartment syndications. They're not correlated at all, right? Same thing with like, if there's a build to rent model, if I'm doing lending on those doing fix and flips, still a very different market than someone doing buy and hold strategy, right? But you can have a little of all in your portfolio, but make sure it's done intentionally. It's that it meets your goals. Now, other things too, like I've started to have a lot of my clients do this. And well, they're doing this because I'm doing it myself, but I'm building up a lot more available liquid cash. For my emergency fund, I use a strategy like infinite banking. You talk about like using whole life insurance, where right now they're paying about 6% a year with they always have a 3% guarantee, but they've never paid as low as their guarantee in 177 years. So I'm pretty certain I can stay above 5% a year with that and stay tax-free and risk-free, right? Even safer than the bank based on how the banks have been operating lately. But I keep the lion's share of my cash reserves there, including my emergency fund that my wife says, do not invest this money. So a lot of our clients are putting the the lion's share of their emergency reserves over there, still keep money in the bank, still have maybe a little money in the high yield savings account like I do too. But I know that high yield savings account, if I make 4.3%, I still get taxed on that 4.3, where I could be making 6% tax free inside of my life insurance, and it's safer than the banks are right now. So I do a lot of that stuff to diversify. And then if I have extra cash that I'm not investing quite yet or building up more dry powder for investments, I'll store it there, and at least make some money and fight inflation in the meantime while I'm building that cash. So having that cash position is so important, is money that you're not investing. If you try to invest every single dollar out there, you're a gambler. Like you are taking big risks. And yeah, you might win big, but again, like I like to know you have a certain path that's going to get you there, even if it means, okay, I might not get there. It might take me an extra year to get to my goals, right? But to know that I'll certainly get to my goals is much better than I might make it. As long as everything works out perfectly, I'll get there. Like you got to be very, very careful of you got to make sure you're staying liquid too.
One final topic, Chris, is as you get more and more successful and your monthly cash flow starts increasing, what tips do you have for people to avoid lifestyle creep, right? The lifestyle creep can really mess up your entire plan.
Well, it depends on who you are. If you're listening to this right now, is if you're more like, if you have more spender tendencies, right? Just pretend that money is not yours, right? The money, the cash flow you're getting is going into your account to then reinvest to build more. If you want compounding income, you got to take that cash and compound it, right? You got to make sure you're taking that cash and putting it back out. And I teach all my clients that. It's like, how do we create this income avalanche? It's almost like in the cartoons, you remember like somebody's rolling down the hill and they get rolling down the snow and then they turn this big snowball and pretty much like this huge snowball that it creates that little avalanche, right? That's what we're trying to do with your income too. And so, be very careful. Be sure you're monitoring your expenses. One thing I have all of our clients do is we actually have them track their money each month. And ideally weekly, not just monthly, but actually weekly, watching how they're spending money. Now, that's for this, especially if you're more on the spender tendencies. If you're more on the saver side, I'm going to give you different advice because you need different advice for different types of people. If you're more of a saver, be okay not to give yourself too hard of a time or guilt trip because it's no secret inflation is way higher than what the government's saying right now. And so if you're seeing your expenses creep up, if you're a saver, you're hating it. You feel horrible. You think you got to tighten the belt even more. And that's not necessary, right? I mean, it does help, but if you're already a natural saver, the thing is that you're going to feel guilty about spending any dollar you have in your life. And so I would challenge you to be okay, maybe spending a little bit more money. By all means, try to be as responsible as you can, which you're going to be anyways, right? But be willing to say, you know what? I'm not, if you're saying, well, because everything's creeping up on me, I'm not going to take that vacation. I'm not going to create those family memories. Invest in those memories, like invest in that. Now, if you're a spender, I'm going to say you're already doing it anyways, so don't invest anymore, right? In your memories, you're going to be doing that. In fact, you might have to take one less vacation depending on your situation, but you can still enjoy life, but not have to be living on rice and beans like some people teach out there. But it definitely, if you're a saver, be willing to be okay that it's going to creep up a little bit naturally. Don't give yourself a guilt trip. Don't feel bad. Think it's your fault. It's not your fault. The economy's fault is what's going on because they're printing more money like Willy Wonka bars, right? It's ridiculous. So just be careful to not guilt yourself so bad that you go in this deep place of scarcity and guilt and shame and then feel like you're not making progress. It's always about progress. Just keep, monitoring what your cash, be responsible with it, have your cash reserves, and then invest everything you possibly can.
Chris, you mentioned that you got a book coming out. When is it coming out? Do you have a title yet? And what is going to be in the book? What can people learn from the book?
Yeah, so it's called Down Millionaire, right? So definitely the topic is more about my journey, and what I've learned and also other people's too, and how that's helped others. But it's really focused on my journey of being a financial advisor, escaping that, getting out of the rat race, only to realize that I got my butt kicked in 2008 because I was an idiot 28-year-old, 29-year-old, right? And the ambition of my 20s caught up to me in my 30s, and I had to bounce back from that. So I talk really a lot about, how did I improve my cash flow situation? How did I come back from that adversity that I had to deal with? And it was bad. I mean, I was in a dark place. 2 years I struggled from 2007 to 2009. So I talk a lot about that. I was able to come back. What did I learn? What are the investments that I talk about? Similar to on this show, just more expanded on this episode. And we're hoping we're doing a lot of drafts. I'm all about done is better than perfect, but I want it to at least not be a piece of crap when it comes out. We're still in the third edit version right now. So I'm hoping it'll come out by the end of 2024.
Excellent. Chris, where can people reach out to learn more about you? And I imagine you have a website as well, right?
I do. Yeah. moneyripples.com is the website. All the social media is at Money Ripples, and you can follow our Money Ripples podcast on YouTube, Spotify, iTunes, wherever you consume podcasts.
Fantastic. I'll put those links into the show notes. Chris Miles, thanks very much for joining us.
It's been a pleasure. Really appreciate it, Gabe.
Hey, thanks for joining us for another episode of the Money Seed podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.